June 2023, Thames Water, Britain's largest water company, confirms it's on the brink of financial collapse. 15 million customers, £14 billion in debt. A business technically insolvent, but still operating. The headlines tell a familiar story: sewage spills, leaking pipes, regulatory fines, executive bonuses, dividend payments extracted while infrastructure crumbled. But this isn't a story about sudden corporate failure. Thames Water didn't collapse overnight. This is the story of how a privatized monopoly serving essential infrastructure was slowly hollowed out by financial engineering while regulators watched, customers paid, and the environment bore the cost. The question isn't whether Thames Water failed. The question is how a company with guaranteed revenue, captive customers, and no competition could fail at all. Thames Water can trace its origins back over 400 years. The New River Company, founded in 1619, was one of the first water supply companies in England. By the 20th century, water provision had become a public service. In 1973, the Thames Water Authority was established to consolidate water supply and sewerage services across London and the Thames Valley. For 16 years, Thames Water operated as a public utility. It maintained infrastructure. It served customers. It answered to the government. Then came privatisation. In 1989, Margaret Thatcher's Conservative government privatised the entire water industry in England and Wales. Thames Water became Thames Water plc, a private company listed on the London Stock Exchange. The promises were clear. Private capital would drive investment. Competition would improve efficiency. Customers would benefit from better service. Thames Water became a monopoly. Customers in its region had no choice of supplier. The company was guaranteed revenue regardless of performance. But it was now answerable to shareholders rather than the state. In 1989, privatisation was sold as modernisation. Britain's water infrastructure needed billions of pounds invested to meet European environmental standards. The government argued the private sector could raise capital more efficiently than the state. Shareholders would demand performance. Markets would enforce discipline. To make the sale attractive, the government wrote off £5 billion in existing water industry debt. It also provided £1.5 billion in public money as a starting grant. Thames Water entered private ownership debt-free and cash-rich. Water companies were structured as regulated monopolies. Ofwat, the industry regulator, would set price limits and performance targets. Companies could raise bills within those limits to fund investment. The model assumed shareholders would reinvest profits into infrastructure. Regulation would protect customers. Competition for capital markets would drive efficiency. None of these assumptions held. For the first decade after privatisation, Thames Water operated relatively conventionally. It invested in infrastructure. It paid dividends. It maintained moderate debt levels. Then, in 2001, German utility RWE acquired Thames Water. In 2006, RWE sold it to Kemble Water, a consortium led by Australian infrastructure fund Macquarie Group. Macquarie specialised in a financial structure called whole business securitisation. This allowed owners to pile on debt and extract cash without selling equity. Thames Water became a laboratory for financial engineering. Under Macquarie's ownership from 2006 to 2017, Thames Water's debt soared from around £2 billion to over £10 billion. The company paid out £2.8 billion in dividends during this period, 40% of all dividends paid by Thames in its first 32 years as a private company. But those dividends weren't funded by profits. They were financed by borrowing against Thames Water's assets. The logic was simple. Thames Water had guaranteed revenue from captive customers. It operated essential infrastructure that couldn't be moved or replaced. Debt was cheap. Investors could extract value by loading the company with borrowings and paying themselves dividends from the proceeds. This wasn't illegal. It was the business model. Macquarie sold its stake in 2017, leaving Thames Water with a growing pile of debt. Current shareholders include Canadian pension fund OMERS, UK University Pension Scheme USS, and sovereign wealth funds from Abu Dhabi, China, and Kuwait. These investors inherited a heavily indebted company. They continued extracting value through internal dividend payments used to service debt at the holding company level. By 2023, Thames Water's total debt stood at around £18 billion. Annual interest payments consumed roughly £500 million, half of the company's operating profit. Investment in infrastructure lagged. Money that should have been used to maintain pipes, upgrade treatment plants, and reduce leaks was instead being used to service debt and fund shareholder returns. Ofwat, the water industry regulator, was supposed to prevent this. Its role was to balance customer interests, environmental protection, and company financial sustainability. It set price controls every 5 years, determining how much companies could charge customers and what returns investors could expect. But Ofwat's incentive structure was flawed. The regulator operated under a framework called the Managed Price System. This allowed companies to recover their costs, including debt servicing, through customer bills. The more debt a company took on, the higher the bills Ofwat would enable it to charge. This created perverse incentives. Companies were rewarded for taking on debt, not for reducing it. Ofwat also prioritized keeping bills low in the short term. This made it politically easier for governments to defend privatisation, but it meant approving insufficient investment to properly maintain infrastructure. When companies underperformed, Ofwat issued fines. But fines were tiny compared to the scale of dividends being extracted. Between 2005 and 2023, Thames Water was fined over £200 million for pollution incidents, missed targets, and regulatory breaches. During the same period, it paid billions in dividends. The fines were a cost of business, not a deterrent. Ofwat also failed to scrutinize financial structures adequately. It allowed companies to use complex holding structures that obscured how money flowed between operating companies and parent entities. When Ofwat finally tightened dividend rules in 2023, preventing poorly performing companies from paying out to shareholders, Thames Water simply reclassified payments as internal dividends to service holding company debt. Ofwat called this a breach. Thames Water argued it was complying with debt obligations. The distinction became a legal and regulatory quagmire. Throughout this period, the regulator maintained that Thames Water was financially sustainable. It wasn't until 2023, when shareholders refused to inject new capital, that the scale of the crisis became undeniable. The consequences of underinvestment became visible in the quality of service customers received and the state of the environment. Leaks were endemic. Thames Water lost around 24% of the water it supplied through leaking pipes. In 2023, this amounted to approximately 630 million litres per day, enough to supply nearly 30 million homes. Many of the pipes were Victorian, laid in the 19th century. Replacing them required sustained investment over decades. That investment didn't happen. Sewage treatment infrastructure fared no better. Thames Water operates over 350 sewage treatment works. Many were outdated and operating beyond capacity. Between 2020 and 2024, Thames Water discharged raw sewage into rivers and waterways for hundreds of thousands of hours. In 2024 alone, discharges totaled nearly 300,000 hours, a 50% increase from the previous year. These weren't emergency overflows during extreme weather. Many occurred on dry days, violating environmental law. In 2022, a BBC investigation found Thames Water had illegally discharged sewage on days without rain. This dry spilling was particularly harmful because sewage wasn't diluted by rainwater, creating toxic conditions fatal to fish and dangerous to swimmers. Regulators prosecuted. Courts imposed fines. Thames Water apologized and promised improvements. But the pattern continued. In 2023, Thames reported 350 pollution incidents. In 2024, incidents rose to 359. The company blamed delayed investments, macroeconomic challenges, and competing priorities. But the root cause was clear: insufficient capital expenditure over decades. The only silver lining is the London Tideway Channel, or super sewer. Finally operational by 2025, it now intercepts millions of tons of sewage, cleaning up the central Thames. Yet this project is a lone exception. It hasn't fixed the wider, crumbling network or the dry spills occurring elsewhere. By 2023, Thames Water had become what financial analysts call a zombie company. It generated enough revenue to service its debt, but not enough to invest adequately in its core functions. The company was technically insolvent. Its liabilities exceeded its assets. But it couldn't be allowed to fail. 15 million people depended on Thames Water for drinking water and sewage services. There was no alternative provider. The infrastructure was too complex and integrated to transfer quickly. The government was trapped. In March 2024, shareholders refused to inject £500 million of promised capital. They declared the company uninvestable under current regulatory conditions. Shortly after, Thames Water's holding company defaulted on debt payments. In May 2024, OMERS, Thames's largest shareholder, wrote off the entire value of its stake, signaling it believed the shares were worthless. Private equity giant KKR initially emerged as a potential buyer, offering to inject £4 billion. But in June 2025, KKR walked away, citing regulatory uncertainty and political risk. Other potential bidders appeared, only to retreat. The scale of Thames's debt, the cost of necessary infrastructure upgrades, and the political sensitivity of the water sector deterred serious investors. Meanwhile, Thames continued operating. Customers still had water. Sewage was still treated, albeit poorly. The company technically functioned, but it was sustained only by emergency debt packages. In early 2025, creditors agreed to provide up to £3 billion in new loans, ranking ahead of existing debt to keep Thames afloat. It was life support. The government prepared contingency plans for a special administration regime, a form of temporary nationalisation used when essential service providers collapse. Administrators were briefed. Legal frameworks were reviewed. But nationalisation carried political and financial risks. Taking on Thames's debt would add billions to public borrowing. Compensating shareholders, including pension funds, would be politically explosive. So the company limped forward, unable to invest properly, unable to attract new capital, unable to fail. Thames Water's crisis exposed fundamental flaws in Britain's structure of privatised utilities. The first lesson concerns monopolies. Privatisation assumes competition drives efficiency. But Thames Water faced no competition. Customers couldn't switch providers. The company's revenue was guaranteed. Without competitive pressure, the only discipline came from regulation. And the regulation failed. The second lesson concerns incentives. Thames Water's shareholders were rewarded for extracting cash rather than preserving long-term value. Dividends flowed while infrastructure decayed. Debt ballooned while investment lagged. This wasn't irrational behavior. It was rational within the system's incentive structure. The third lesson concerns regulatory capture. Ofwat was supposed to protect customers and the environment. Instead, it prioritized companies' financial stability over service quality. When performance deteriorated, Ofwat issued fines. But fines didn't change behavior because they were dwarfed by the profits being extracted. The fourth lesson concerns accountability. Thames Water's ownership structure, involving offshore holding companies, pension funds, and sovereign wealth funds, diffused responsibility. No single actor could be held accountable. When the company failed, shareholders blamed regulators. Regulators blamed shareholders. The government blamed both. Customers and the environment bore the cost. The fifth lesson concerns public risk and private reward. When Thames Water succeeded, profits flowed to private investors. When it failed, the public sector faced the bill for rescue and cleanup. Privatisation transferred upside to shareholders while socialising downside risk. As of late 2025, Thames Water's future remains uncertain. A consortium of creditors, calling themselves London and Valley Water, proposed a rescue plan. They offered to inject £5.4 billion and write off a third of Thames's debt in exchange for control of the company. But their plan included demands for regulatory leniency. They wanted up to 15 years exemption from pollution penalties, arguing this was necessary to make investment viable. Environment Secretary Steve Reed rejected the proposal. Granting immunity from environmental crimes was politically and legally untenable. Talks continued. Creditors threatened to force Thames into administration if their demands weren't met. The government intensified preparations for temporary nationalisation. Meanwhile, Thames Water kept operating. Bills rose. Service remained poor. Sewage spills continued. The company serves 15 million people. It cannot be allowed to fail. It cannot succeed under its current structure. This is the paradox of privatized monopoly infrastructure. Essential services require long-term investment and stable stewardship. Profit-maximizing shareholders require short-term returns. These objectives are incompatible when regulation is weak and accountability is diffused. Thames Water didn't fail accidentally. It did exactly what the structure rewarded. It extracted maximum value for shareholders while deferring investment costs onto future customers and the environment. The model worked perfectly, until it didn't. Britain now faces a choice: rescue Thames Water and risk repeating the same cycle, or restructure fundamentally, acknowledging that some infrastructure cannot be run purely for profit. Other countries approached this differently. In France, water services operate under delegated management contracts with strong public oversight. In Germany, many utilities remain in municipal ownership. Britain chose full privatization with light-touch regulation. 35 years later, the country's largest water company is on the brink of collapse. Its infrastructure is failing, and its rivers are polluted. The question isn't whether privatization failed. The question is what comes next. Thames Water remains a zombie utility, sustained by debt, propped up by emergency funding, unable to invest or fail. The structure rewarded extraction over maintenance, shareholders over customers, short-term profit over long-term sustainability. And when the model broke, it left taxpayers, customers, and the environment to pay the cost.